Hey, Nick Supik, Century 21 Real Estate. Hope you're having a blessed day. Today I want to talk about no money down loans. You can see there's USDA, VA, and we're going to talk about FHA. No, that's not really a no money down loan, but so no money down. It means what that means is 100% financing. So literally, I like to talk about round numbers. So if you're buying a $100,000 house, 100% financing means you are borrowing $100,000. Pretty straightforward. Now your payment's going to be based on the full amount. You're not putting any money down, so technically your payment's going to be more than normal. If somebody's putting down 5, 10, 20%, obviously you're kind of bringing your payment down some just by doing that alone. So USDA loan, what's that stand for? It's United States Department of Agriculture. So United States Department of Agriculture, and their objective, from my understanding, don't quote me, like this isn't verbatim out of their website. You literally just Google USDA loans, and like their website pops up. So what my understanding is, they're trying to help people get loans that would be in a more, I'm going to use the word rural area, so a non-urban area. And they just have a website. You type in the address of the property. Does it qualify? So the city of Pittsburgh, generally speaking, it used to be like Allegheny County altogether. None of that qualified. But I think there might be select areas, because they are always constantly updating their map based on population of areas, townships, municipalities, that type of thing. So generally speaking, it's a decent interest rate. And there's something called PMI. I don't know if you know what PMI is. Private mortgage insurance. Private mortgage insurance is not insurance for you. It's not insurance insuring you at all. It's insuring the loan, and what that means is you're paying a premium above the interest rate towards this insurance. And once you've typically, how it works is, once you've gotten about 20% down, or paid down 20% equity in that loan to value of the property, that mortgage insurance goes away. And so USDA's mortgage insurance is typically on the lower side, comparatively speaking, to FHA, though I know I don't want to talk about any absolutes, because rules and loans are constantly changing. I know FHA just made adjustments to their PMI rates, so and they're going up and down. They used to be so it used to be for like a certain, once you've paid down so much on it, and then they just went to the life of the loan, so you end up having to refinance your way out of that. In any event, so USDA, again, so their goal is to put you into more of a rural area, which a lot of people like that, so it's good. There's different. So every county has, the county seat of the area. You Pittsburgh and Allegheny County, Butler, and Butler County. Was it Washington County, Greensburg over in Westmoreland County. So commonly those are your more populated areas, and then if you stretch out from there, you normally get into a more rural area, and then USDA would qualify. Now there's income limits on that. I'm not going to speak to that exactly, but high income earners commonly do not qualify in these types of loans. But again, there's like a combined household income that they qualifies for that. I put a link in here that's John Kearney, Victorian Finance. I did an interview with him. You can probably find it on YouTube or Facebook here. He's going to be the guy that you want to contact in order to get more particular information on that. He can qualify you for these loans. And so VA, Veterans Affairs loans. VA, you have to be a veteran. You have to qualify through the Veterans Association, Veterans Affairs, to use your veteran loan, to use your VA loan. Again, 100% financing. It's a pretty good loan in the sense that VA takes care of their veterans. You typically get a really good interest rate, as good a market rate as you're going to get. The only caveat typically with a VA, if you're like, hey, I have finances, I don't really need to use my VA loan. The only reason you would use it is to make sure that the rate's comparable to what you can get market rate, and then also there's a funding fee that people pay. I'm not going to quote it because it hypothetically changes, but I don't think it really does. But there's a funding fee that's financed above and beyond the loan. So again, round numbers, you finance 100 grand. There's a 1.5%, 2% funding fee goes on top of it. So now all of a sudden you're financing $102,000. But don't quote me on that rate, that fee. So USDA, I believe, actually has a funding fee too that gets wrapped into the to the loan a little bit, probably a 1 or 2% thing. So again, I'm not going to speak to that specifically there. So that, again, no money down loan is really good for somebody that says, hey, I actually have a good income. I have, I'm renting right now. I'm paying $1,500 a month in rent, $2,000 a month in rent. I really would like to buy a house. I just have a hard time saving the down payment. So this would be that scenario. Hey, you're doing well income-wise, but just don't have you need to qualify, credit-wise and everything there too. So you need your income, you need your credit. So you have to be employed typically for so much time. They have different requirements there. So I'm just going to speak, since I've spoke about those two, VA, so the last one, FHA. So it is actually not a no money down loan, but it's a low money down loan. So it's 3.5%. So using the round number scenario of 100,000, 3.5% is $3,500. So you could buy a $100,000 house, need $3,500. Are there other closing costs? Yes. So when I say USDA, VA, FHA, you do have to put down. There is money, down closing costs involved. Depending on taxes, insurance, there is some loan costs involved. That can be negotiated to be paid by the seller. Each one of those has a little different requirements. Normally, the maximum you're able to get is like 6%. So that's, round number, $6,000. There's times I think 3%, 3 or 4%. VA used to be 3 or 4. I think it has gone up to 6 at this point. In USDA, I'm pretty sure it's still at 6%. But so you can normally get 6,000. Now that's a negotiation. Then there's no assumption the seller will pay those costs for you. In a market that is more of a buyer's market is when you're going to get the seller to do that. When it is a seller's market and you are having to work in a competing offers against other buyers is when the seller is commonly not going to want to do that. Or you end up having to offer above the asking price and then say, hey, so a scenario, hey, I want the house is listed at 100,000. You're going to put zero money down. You need the seller to pay your closing costs, so you can ask for 6% back, which is now $6,000. So you're going to offer them $106,000. Hey, you're asking $100,000. I'm going to offer you $106,000. I'm going to ask for you to give me $6,000 back towards closing costs, and so you can essentially come in with no money down. There sometimes is still some costs. There might be $1,000. You're going to commonly put down hand money still, so maybe you put $1,000 hand money down. So then you're going to be pretty close to breaking even. I've seen in some scenarios, if it's a $200,000 or $250,000 house and you ask for get 6% back, where you're what $12,000, $15,000. You normally don't need $15,000 on a closing cost on a $250,000 house on a 0% financing, zero down loan. So FHA does have a different there's not necessarily a funding fee. But there's PMI costs are different. VA, the reason VA is cool is because there is no PMI, the private mortgage insurance. There's no additional cost involved there. So kind of throwing a lot out there. I hope this helps. I would call John Kearney, talk to him, say, hey buddy, what's going on? What's the best option for me? I'm not a veteran. Can I do USDA? I'm looking at a house in this rural area. Make sure it doesn't, they'll literally have a map. You can type in the address and the eligibility, and it's going to have a map right here. And it's going to say, is it in it or out of it? And then, if it's close to the line, that's kind of scary because hypothetically the line changes. I don't know how often they do it, but I've had scenarios and I've heard of scenarios where in the middle of the loan, that map changed. So that's scary. USDA loans sometimes can take a little longer. It's better to do them earlier in the year because I think as the year wears on, like some of their funding starts to, they lose some of their funding. They don't, they made a bunch of loans. So I hope that's helpful. I hope this information, finds you capable of doing something and gives you some hope and maybe buying a house this year. And if not, you're saying, hey, I want to look at other options. Again, John's a good guy. John, you check out the message, the video we did with him in the interview. So they have a lot of options available to them. So appreciate your time. Hope you have a blessed day. And I believe that every buyer and seller should feel confident when it comes to buying and selling a house. So appreciate you. Bye.